Good morning. It's 10 o'clock on Thursday. That means it's real estate now. Stacy, good morning. How are you?
Good morning. Good morning, Keith. I'm really good. Thanks for asking.
Awesome. So, hey, let's jump right into it because it's been a volatile week. So, here we go. I think it's going to pop up here. Rates continue to decline. Stacy wins, right?
I keep winning this race.
But the last 2 days have been very volatile with the no longer theoretical inflation numbers that are going to be presented. The actual inflation numbers were presented yesterday, and they were a little bit higher than they actually forecasted. So we saw
they were about
double. Yeah, like double.
They were double what they were expecting. Yeah.
Yeah. So the trend over the last 2 days has not been in this direction of declining rates. It's been in increasing rates. So I think, just my theory, we're going to tick back upwards next Thursday. So there you have it.
It is so volatile. Just to make this fun, I'm going to stick with downward trend.
Oh, really? You think it's going to bounce back?
I do. Yep.
There you go. There you go. Well, there it is. Here again. We like to talk about this ping pong game, but really, rates are still right around 3% or below 3%, depending on your overall credit score and loan to value and all that good stuff. It's amazing. So just jump at the money, get in there, get it done. It's still not too late if you missed the trough back in the end of last year to jump in and still get an amazing rate on a refinance or buy that house or buy the second home or do anything mortgage related. So don't hesitate. Now's a good time. So who do we have lined up today?
Today we have lined up Kyle Williams. Let's bring him in.
Kyle. Oh, hold on. Where'd my mouse go? There we go. I did it. Technology works, Kyle.
Here I am.
Kyle, you are with 1031 Exchange Facilitator. No, 1031 Partners.
IPX 1031.
IPX 1031. Okay.
Yep.
What does IPX stand for?
Investment Property Exchange.
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 So we spelled it incorrectly, but on purpose.
Got it.
Hey, we have a capital letter in the middle of our name, so we get it.
Yeah. There you go.
So tell us what a 1031 exchange is for those maybe new or maybe thinking about selling some investment properties. What is a 1031 exchange?
Sure. So 1031 it's really a section of the tax code that allows investors to sell one investment property, or even multiple investment properties, and use all the equity, not just the after-tax equity, to reinvest into something bigger and better, hopefully, and not pay federal taxes along the way. They're deferring the taxes.
There it is. So it's not like a tax-free thing. It's just you're punting the tax obligation to a later date.
Yeah. So one, there's a phrase in 1031 called swap until you drop, right? Like some real estate investors are always going to own real estate and they're going to pass it on to their heirs tax-free and plan out their estates. Most people don't think that far ahead and plan like that. But at the end of the day, we're all fairly young. Why it's important to us, even if we plan on paying taxes down the road, is that if we sell a duplex for $1 million, we've owned forever, fully depreciated, et cetera, instead of only being able to reinvest $750,000 or $800,000 after taxes, we get to reinvest that full $1 million. And I'm not taking it into account closing costs and stuff, but you get the point. You got a lot more money working for you instead of going to the government right then. So it's literally the greatest wealth building tool for the middle class and really for people who again want to build wealth through their higher earning years. Because if you can't take out money out of your retirement plan right until you're 59 and a half. But for all of us, it's like we could collect income from a rental, buy and sell, and not pay taxes. It's pretty cool.
That's super awesome.
So to go back what you said about deferring, so you either defer till you die, or you defer until you get to a point where you want to sell the property. Is that what most people do? And then that's when they pay the taxes?
Yeah, so they may plan things out. I mean, they could theoretically end up going like passive down the road and, REIT-type investments like DSTs and then fractionally sell incrementally. They may diversify into like smaller rentals. Say they sell a duplex in Ballard for 1.2 million. They may end up buying 5 or 6 rentals in Spokane and slowly sell those off down the road, so it's not one big tax hit at once. So there's definitely ways to plan accordingly, even if you do plan on paying taxes.
So just to clarify, you said investment properties. You couldn't do this on your owner-occupied house, correct?
Correct. So owner-occupieds, they have what's called the 121 exclusion, a different section code. But for those clients that have lived in their primary residence for any 2 of the last 5 years, they get $250,000 tax-free if they're single, $500,000 tax-free if they're married, and they can take that every 2 years.
I bet there's some people in Seattle right now that are getting very close to that over the past few years.
Right?
Say that again for our audience. What do you mean you can take that every 2 years? Do you mean
go ahead. Yeah, so let's say, because you live in it 2 of the last 5 years, theoretically, you could live in 2 different properties 2 of the last 5 years. Let's say that I lived in one, 3 and 4 years ago, and this last one 1 and 2 years ago. If I take that exclusion on one of the properties, say the 3 and 4 year ago property, I wouldn't be able to take that exclusion again, the $250,000 or $500,000 tax free for 2 years. So I'd have to wait a tax year before I take it again. So I can sell one property now, take the $250,000 or $500,000 tax free, and then sell the other primary residence that I lived in 2 of the last 5 years, sell that in 2 years and take that $250,000 or $500,000 tax free again.
So let me ask you an extreme example, again, for our listeners, that this is brand new for them. So you take a $1 million house 3 years ago, they put $500,000 down. The property is now worth $2 million. And they're paying taxes on $1 million and saving on the $500,000 that they originally put down, or where are they at there?
Yeah, so they bought for $500,000, right?
They bought for $1 million and put $500,000 down.
Oh, they bought for $1 million and put $500,000 down. So that gain on their primary residence is $1 million, and so they would get $500,000 at, assuming it's 2 spouses. They would get $500,000 tax free, so that puts it up to 1.5, their basis essentially, and then 1.5 to 2 that would be taxed.
Got it. Okay.
So they do knock off a pretty big section, essentially half their tax bill.
Yeah, that's awesome.
Yep, absolutely.
So let's pivot back to 1031 exchange. So now, when you go to do a 1031 exchange, when should people reach out to you to start this? Is this after they get it under contract? Is this before they list the house? When should somebody look into 1031?
I'm glad you asked me this, because nobody ever asked me this, and this is the most important part of the equation. When do you need to set it up? So if clients want to reach out like early in the process before they've even listed their property and ask basic questions, I'm more than happy to do that. We can't set up the exchange until they're under contract though. But they need to set up before they close escrow. Because once it's closed, they have what the IRS calls constructive receipt of funds, meaning control of funds, and the exchange has failed. And so I get this call all the time. I mean, it feels like a daily basis where someone will call and say, hey, Kyle, I hear you're the 1031 guy. I need to set up an exchange. I'll say, great, where's escrow? And they'll say, oh, it closed last Wednesday. I'm like, it's unfortunately too late to set up the exchange. And they'll say, oh, are you sure you know what you're doing here? Because my broker told me that it would be easier to set up after I close on my sale. I'll never say this, but in my head, I'm thinking that broker is about to be known as defendant, because they just walk their client into a huge tax bill.
Wow.
So we tell everyone, I mean, even ourselves, if there's questions you're unsure about, refer them back to their CPA, because you can never go wrong doing that. And ultimately, that's where things fall. So when agents and brokers and like lenders, title and escrow, you guys are all heavily regulated. So you take on liability when you discuss real estate tax law. And so that's why we tell brokers, just refer to us, refer to their CPA. Don't try to play the guessing game if you're unsure. That's not okay.
Yeah, I wholeheartedly agree with that. I do not play CPA at all. Whenever tax questions come up, I'm like, you need to go talk to this person or that person or your CPA or what have you. But not my license. So sorry, I can't help there.
It's something we talk about a lot with our team. To make sure.
That's good clarification, because I thought you had to set that up before you had mutual acceptance. So it's just before the funds are at escrow and closing.
Correct. And everything is, So before, like in the old days, which, 24 months ago, we could set up an exchange like relatively quickly, like within a day.
Right.
And now we theoretically can, but like title and escrow so busy, we're busy, everyone's so busy, it's hard to do a rush like that. So generally we ask for like at least a week or so before closing. The more time the better. But yeah, they actually can't set up until they're under contract and they've gone mutual.
That is good to know, because one of my teammates yesterday on our daily help call, they're like, they're trying to do a 1031 exchange and we're closing next week. I'm like, have they set it up yet? They're like, no. I'm like, they better do that.
Yeah.
So that's good to know. I'm going to pass on your information.
Awesome.
I was going to say, yeah, send that one to Kyle. But just to clarify for everyone out there, what exactly does your company do? So you're not escrow, you're not a CPA. What are you?
Great question.
Very good question. So if I were to describe our job to someone who didn't know much about real estate, I would first say we're really just like escrow. Like when you sell a property, escrow holds funds and then we'll wire them to your account. And they're like, okay, yeah, I get that. But with 1031s, everything's still the same. Clients still set up escrow, close, everything like they normally would. But instead of escrow wiring money to their bank account, they'll wire money to us to a bank account we hold on their behalf. And then we wire out funds when they close on their purchase. So our job as a disinterested party is literally just hold funds for the duration of the exchange. So it's like another layer of escrow. That's probably the easiest way to look at it.
Okay, so I'm thinking out loud. You guys sound like you've been put into place by the government to make sure the proceeds of non-owner occupied properties don't get commingled with other assets or utilized in a different way while they're trying to find their next house. So you guys are like a trustee to park the money.
Kind of, yeah, that's probably a good way to look at it too. The big thing is the clients can't control funds because 1031 started out exactly 100 years ago, 1921, as a deed swap. For like farmers who like wanted to rotate crops, it was a true deed swap. That's where the word exchange comes from in this context. But so the idea is that you could never really control money. It was a true deed swap, and then 79, so a little over 40 years ago, it changed from deed swaps, two-party exchanges, to three-party exchanges. But the IRS is very clear: you can't control funds. You need a disinterested party to hold your funds for the duration of the exchange, which is why you have to set up a 1031 before you close. You can't have control of the money.
Interesting.
Yep.
There you go. Okay, so then great. We've had this non-owner occupied house investment property. We sold it. You guys are holding on to my cash. Now what do I do?
So your job is to find new property. After you close on your sale, you have 45 days to identify, which means let us know in writing what you intend on purchasing, and 180 days to close on that property.
Okay.
So you have to find new investment property relatively quickly to purchase.
Does it have to be mutually accepted?
So you don't have to be under contract within the 45 days, but you probably want to. Theoretically, you just have to let us know in writing what you intend on purchasing. But yeah, I mean, that may work in Minot, North Dakota, but around here, as you guys know, a property, if you just put it down on a list on day 45, it's going to be under contract somewhere by day 50. So around here, you definitely want to be under contract within the 45 days.
Okay, good to know.
What like for properties or whatever the term is that people
yes. Another good question. So yeah, one of the most common questions we get is, Kyle, I heard about this like-kind thing. I'm selling land. I guess that means I have to buy land, right? Nope. You can buy any type of real property held for business or investment use. So you can get off into the weeds. So like rentals are the most common, commercial, but land works, 30-year leases, like cell phone towers, easements, water rights in our state, mineral rights anywhere. So you can really get off into the weeds. So the better question is what doesn't qualify as like-kind in a 1031 exchange? Personal use properties, so like primary residences, second homes, flips don't qualify, and new developments to be sold. But other than that, it probably qualifies. So yeah, so clients like landowners especially, a lot of landowners they'll say, yeah, I've owned this land for 35 years and yeah, I've made some money on it, but I had no idea that I could sell and do this 1031 thing and not pay taxes and put that stagnant equity to work and, exchange into a rental, for example. And it's like, absolutely. So
that's awesome.
Yeah.
Where do our fine Airbnb folks fit? The second homey, let's rent it out half of the year kind of thing.
So yeah, good question. So second homes don't qualify for 1031 treatment.
Okay.
So the first 2 years that they own it, they can stay there for really a couple weeks a year for each of the first 2 years. And then after 2 years, they can do with it whatever they want. But the first 2 years need to be held for business or investment use. They don't have to rent it full time, but yeah, they can put on Airbnb and rent it out half the year if they want to. But this is also a good idea for your clients who maybe are getting close to retirement, own investment properties, and want to exchange into their dream home. So they can sell. Say you work with a Boeing engineer that's retired now, and they have three rentals in the area, all $900,000 each, and they want to sell those rentals and put that money down on their dream home on Lake Sammamish. They can do that. It's just the first 2 years after they exchange into that dream home, they need to get some rents on it and limit their own personal use. But they could rent it to a friend. They could call Keith and say, Keith, rent this from me for a couple weeks this summer or a couple weeks next summer. They've satisfied that requirement. And then after 2 years, they can move into there, retire there, die there, never pay taxes on it. So
wow,
there's a lot of cool things like that for for the clients that are listening that are retirees or no retirees. It's like, that's a great talking point for them that a lot of people don't know about. That they can exchange in their dream home. They just can't move into it for 2 years.
Just takes a little planning. You just got to know, right?
Yep, absolutely. Just plan.
This is such a good conversation to show people the importance of seeing an expert in any field. Because I've been in this for 21 years. I feel like I know tax exchanges, but I've learned like 5 things just listening to you.
Wow.
So I know this is really beneficial, I'm sure, for just the general public.
Sure.
So we're on our 100-year anniversary and things are changing a little bit, possibly. Can you kind of give us insight into the new administration?
So it's really tough to say right now what is going to happen. And again, this is something that everyone who calls wants to talk about, and everyone's got an opinion one way or another on the administration. Just like they did the last administration, I think going forward, everyone's going to have their opinions. So that being said, I don't, from a political standpoint, I mean, it's President Biden's administration has made it pretty clear that they want to close 1031, as they call it, a loophole, which it really isn't. But I will say this, is that 4 years ago, we were very concerned that President Trump at the time was going to get rid of 1031s. That, it was going to be part of his budget plan, and he was going to need support from the other side of the aisle, and he'd put this in there as a concession. And so we didn't know if even he did. And at the end of the day, if you look at it from a purely political perspective, people on both sides of the aisle, Democrats and Republicans, do 1031 exchanges. If you think of like donors too, who really move the needle with our Congress and our president, they've all done 1031 exchanges. So at the end of the day, and they understand too, that most importantly, the middle class builds wealth this way. So if they want a lot of angry middle class voters, which nobody wants, especially right now, all they need to do is get rid of 1031s and they will have angry voters. So I personally, it's definitely a threat, but I personally don't think it will happen. I mean, say what you will about the government, but I don't think they're dumb enough to cut their nose to spite their face. And that goes for both parties.
Yeah.
So not to get really into politics, but is what's out there, is that what is sort of being chatted about, is actually rid of it or changing it?
So right now would be to change it and limit gains to 500,000. Earlier in the fall, they said that they wanted to close it, essentially get rid of it. Right now, I think so this isn't even in a bill yet. It's really just scuttlebutt that was leaked to Bloomberg through one of their articles, a couple weeks ago. But yeah, it's really tough to say right now what's going to happen, what the final bill will look like, if they'll even put it in there. But as it stands right now, the latest word would be to limit gains to 500,000, which, yeah, again, that works in Minot, North Dakota. But if you have a rental in King County, it's like a $500,000 gain is not a lot for some people. you know?
Yeah, especially given the last 5 years of exponential growth and the appreciation.
Absolutely. Yeah, can you think if you have a triplex in Kirkland that you're going to sell for 1.4 that you've owned forever? It's like you're going to have more than 500,000 in gain, and yeah, having 500,000 taken off, that's to defer the tax on. That's awesome, but a lot of these people, again, they're going to build so much more wealth if they get the full amount to exclude. I know Ernst & Young did a study in 2015, and they just updated it recently. But as of 2015, their study concluded that if they got rid of 1031s, it would have a negative net impact of over $100 billion on the economy.
Whoa!
Over the next decade. I think PricewaterhouseCoopers, one of the other big four accounting firms, was closer to like 150 or 160 billion in their estimate. And so you think of how much in the 1031 world in the real estate world is derived from 1031s. It's astronomical. And I tell brokers this and other lenders, it's like, even if you've never been involved with a 1031, even if you don't know what a 1031 is, you've still been affected by it. The other party in a transaction, somewhere you've been involved in a 1031. And so, it would really hurt middle-class investors, and it would really hurt the real estate market long-term if they were to cut back on 1031 or eliminate it.
Yeah, that'd be a substantial impact. Now it did just trigger a quick question. We've talked about residential real estate and some land here and there, but like commercial buildings too. If you're an apartment owner or a mixed-use strip mall, anything commercial realm is in this, right?
Absolutely, yeah. So yeah, if you've got a strip mall down in Lacey, Washington, and you want to exchange that for rentals in King County, you can absolutely do that.
Gotcha.
Yeah, so commercial is a big space, and it's moving more. And we've seen, a lot of people exchange out of like office, and they get nervous about office space, and they'll exchange out of that into industrial or something that they think that they can make more money on long term and not have to worry about as much. So like kind is a pretty broad definition for people if they want to get out of their current asset class within real estate.
Like, is there a ceiling? Is there a ceiling on this as far as transaction number?
So you can do as many exchanges as you want.
Okay. But what about like sales price? I've got $100 million thing that I'm going to sell, right?
Sure. Yeah.
Okay,
so there's
1031 that?
Yeah, absolutely. Yep. There's no cap on the price. And this has been the thing that originally started this conversation with getting rid of 1031s, is that Trump has done a lot of 1031s. I mean, that's how he's made, probably a good chunk of his money is deferring taxes in the sale of commercial properties. And so they'll say, this is, a loophole that Trump's used. But at the end of the day, say Trump does a 1031 and saves $5 million in taxes. If we do a 1031 exchange on a rental and save, 100,000 or even 50,000 in taxes, even though we're not saving 3 million or 5 million, our tax savings go further for us than they would for him, Yep. So at the end of the day, even if you sell $100 million building and you're some big partnership, your tax savings don't mean as much to you as they would to someone like us that don't own $100 million buildings. Right. I don't know, maybe you guys do. I'm just guessing here. I'm using a long
No, Keith and I absolutely do not. But you've mentioned quite a few local cities, which is great. Do you help people out of state? Can you do exchanges from Washington to Idaho? Like, how does that work?
Yeah, good question. So 1031 is federal. So clients can exchange between all 50 states, Guam if they show certain income requirements, Virgin Islands, not Puerto Rico, but essentially all 50 states. So so everything's done basically with COVID now via DocuSign, and we wire funds out. So exchanges can be done anywhere.
Gotcha. Yep. Okay, so we're coming into the final stretch here. How does this whole process get initiated? Because when we take a listing and we set up the real estate agent relationship, the real estate agent's handling title and escrow. Are clients working through the real estate agents to engage you, or does the client engage you directly?
Good question. It can definitely be both. Okay. We'll eventually have to talk to the client. A lot of brokers are super hands-on and they have that concierge type service where they want to do everything for their client. That's
Sure.
awesome. We'll eventually need the client to DocuSign. But yeah, at the end of the day, most clients will want to talk to us. They'll have basic questions. They'll want to know about the process. And really, at the end of the day, I tell them it's fairly straightforward. In a 1031, you just want to do two things: buy for equal or greater value and reinvest your proceeds. That's about all you have to do. Our job is to hold funds, and then you'll let us know when you're ready to purchase, and we'll wire funds out for that. But the process itself is pretty straightforward. Really, an exchanger's job, just find new property.
Did you say? What are the two things? Was it find a property of more value? Was that one of the things?
Yep. Buy for equal.
Okay.
So it could theoretically, so it's sales price less non-recurring closing costs. So if you sold a rental for, say, $700,000, your true equal or greater target, once you took off like broker commissions and recording and all that, might be like, I don't know, $636,000. Yeah. And so, yeah, you'd want to buy for at least $636,000. If you were to say buy for $500,000 and buy down, you defer taxes on whatever taxes there were on the $500,000, then you'd pay taxes on that sliver that you bought down for.
Got it.
Gotcha.
Yep.
I'm also going to do this right now. I'm going to put your link to your website so they can find you, not just email you, they can also find you on the World Wide Web.
Awesome. Very cool.
Yeah.
The internets.
Yeah, the internets. So right on. Well, Kyle, thank you so much for joining us today. Any last words that our viewership should know about 1031s before we say goodbye today?
Yeah, so one big thing is, especially with lenders, is one, get your lenders involved early in the process. Make sure everything's lined up by the time you close on your sale. You're pre-approved, you've applied, whatever the case is. Make sure you guys are involved early because if clients drag their feet on it and wait, then it can throw everything off. And clients need to understand too that they can't apply for a primary residence loan when they're buying a rental. And we've had lenders call them, they say, hey, this client just applied for primary residence, but they're doing a 1031. You want to talk to them, or do you want me to? I'm like, yeah, we should both talk to them. So, but yeah, other than that, no, I really appreciate being on, and yeah, if anyone has any questions, feel free to reach out.
I've had that conversation. I've had that exact conversation, Kyle. I'm like, so where's the down payment coming from? Oh, it's over at the 1031. I'm like, yeah, we're not doing this. So that is a very good point, that not even just 1031 stuff, but if you're going to list your house, know that your next transaction is possible, whether you're doing a investment to investment or you're doing a primary to a primary. And even over this past year, I've had clients come to me like, hey, we're already under contract. We're going to go buy our next house, only to come to me post mutual acceptance on their sale that they can't qualify.
Yeah.
And it is a very difficult conversation. So know that your next step is possible before you sell that house. Whether it's 1031 or regular, come talk to us first. It's super important.
Yeah, they should definitely be talking to you guys before they even talk to us.
Yep. Especially if you're self-employed. And that's typically where we get caught. It's those folks that have been with Microsoft for 20 years and then decided to open up their own consulting firm. And they've been there for a year with 1 year's worth of tax returns, and boom, the deal blows up. So, fun
it's
time.
Not funny, but
it's our experience that we can share with folks, just so they never have to go through it again. That's why we like to share these stories. It's not because we want to poke at people's unfortunate circumstance. We want to prevent it from ever happening again.
Yep.
So right on. Well, enjoy the sunshine, Kyle. Appreciate your time, and we'll definitely catch you next go around.
Awesome. Thanks for having me.
Yeah. Well, there you have it. 1031.
That was awesome. I'm gonna go buy some land.
Go buy some land.
Go buy some land, and I call Kyle in 5 years. We're gonna be set.
There you go. Yeah, I'm going to definitely pass Kyle's information on to our teammate here. So,
that's great.
Well, join us next Thursday for Real Estate Now, and we'll see you right back here at 10 a.m. Thursday morning. Have a great day.